market wants.
Well, welcome to this special show. This is the third edition of What Market Wants, and our guests today are Sunil Singhania, founder at Abakkus Asset Management, and Hiren Ved, CEO and Director and CIO at Alchemy Capital Management. Gentlemen, good morning. Thanks for joining us. Sunil, from portfolio investors' point of view, it's been a good year, or the last 1 year has been good. What should be the key expectations from the budget? What would be your top call?
Hi, Anush. Thanks for having me. So I think if you look at the budget over the last few years, the relevance from a capital market perspective have not become zero, but has started to get a little bit diminished from a year on. I think as far as the markets are concerned, obviously there are a few things. I don't think there's going to be too much tinkering as far as the taxation is concerned, both direct as well as indirect. However, what the market would be looking at is a direction as far as the growth in the economy is concerned. So, maybe extension of the PLI scheme to cover more sectors, or maybe increasing the allocation, more spending on, the planned expenditure rather than the unplanned expenditure. I think all of us are in sync that fiscal deficit is going to be continuing to be high at around 6%. So that shouldn't be an issue. But I think these would be the major things, I would say, spending on the capex and planned expenditure rather than the unplanned expenditure.
Gentlemen, good morning. Prashant here. Sunil and Hiren, good to have both of you here on this special. Hiren, so in a way, quality of expenditure is of paramount importance. Is it all going into sort of paying for revenue expenditure, more towards capex? What is your sense?
So I think, hi, thanks for having me on the show. I think it's important that, the capital expenditure is amped up because I believe that there is a need to stimulate the economy, especially at the lower end of the market, because the urban consumers have had it okay and good, but I think there is stress on rural consumers, and with the inflation biting into their purchasing power, I think it's important that there is spending that happens at the bottom of the pyramid, right? So if you look at the commentary of Hindustan Unilever, if you look at the sales of two-wheelers, you can make out that there is still stress on the rural side, and therefore more capital expenditure focused towards construction in rural areas, whether it is housing or infrastructure, I think would be very, very welcome. And I think the second thing is from a market perspective, is divestment, right? I mean, we have a very aggressive plan for divestment, and I think what the markets would look for is a continued focus on divestment and actually then execution on the same. So I think that's going to be very important. Otherwise, I think taxation is now more or less out of this budget. It's largely, done and dusted with. I think corporate taxes are pretty competitive, and the rest of anyway is dealt with by the GST.
That's true. So, Sunil, thanks for joining us on the show. You started by saying that the importance of the budget has diminished from an equity market standpoint. Are there any tweaks that the government can make on the taxation front, on the compliance front, which will be positive from an equity market perspective, more so from a foreign investor perspective in the market?
So Sonia, if you see, actually, the government has done whatever they could, so this higher taxation on the rich, they've already done. We have a peak taxation well above 40%. We now have dividend tax, we have capital gain tax, we have buyback tax. So I don't think there is anything negative which can come in. I don't expect the government to reduce any of these taxes because they've just been introduced in the last 1 or 2 years. I think what might basically just be the case would be a little bit of tinkering, maybe like SEZ tax, for example. Now everyone is working from home. So there might be some clarity that even if you work from home, IT companies in particular might be able to take advantage of that. But other than that, I frankly I don't see anything which is possible or which is on the cards as far as direct taxation is concerned.
Okay, fair point. Hiren, good morning. So, from the market point of view, how should investors approach this year? Because there's been so much which has happened over the last 2 weeks or so. So many of these high valuation stocks have seen such a sharp drawdown. From the market point of view, what would be your approach now?
So hi Anuj, I think we continue to be constructive on the markets. I think if you look at the earnings picture and even if you look at the numbers in the third quarter, right, a large part of your Nifty, which is the banks, Reliance, and the tech companies have all given very decent results. They have either met or exceeded expectations. So I think broadly speaking, the corporate earnings picture seems to be good. And I think as the impact of Omicron wanes, and all the restrictions are lifted, you will continue to see improvement, during the year. So I think clearly right now there is, some correlation where globally, high valuation stocks are correcting, pricing in higher interest rates around the world, and therefore India is not immune to that. But I think overall, if you look at the picture on the economy and the earnings, I think, there is, we need to be positive, and I think one should tilt your portfolios towards companies which will actually benefit from the economic recovery.
Economy facing. Sunil, your sense exactly on that point in terms of how stocks are priced. And, the impact of the budget barely lasts. I remember in the last budget, because expectations were low because that was the first budget coming out of COVID, because, in 2020, the budget happened, the budget was presented right before COVID lockdowns, etc. So expectations were low in 21, but the allocation towards capex was higher. But the market reaction quickly faded. In terms of viewers who are watching this and wondering about stock implications, especially on the capex side, what would you tell them?
So I would reiterate, Prashant, actually, if you see the impact of the budget on the markets have started to reduce, and the volatility on the budget day as well as post-budget day has also come off a little bit. Yes, it's historically been a day to track. All of us get very excited and very engrossed in the budget day. And there is multiple view which keep on coming on the budget day and the day after. But I think overall, if you just, elongate the period to maybe 15-20 days pre and post budget, the impact of the budget on the equity markets has reduced quite significantly. I think ultimately what has also started to happen is that the markets have also matured a little bit, and they have started to look at it from maybe a 3-5 years perspective. And I think this budget should be no different. I think we are already seeing a healthy correction in the run-up to the budget. So good thing is that the expectations in the run-up to the budget are not as elevated as normally they tend to be in the past. And I think that also, at least from our perspective, gives it a lot of, I would say, credence that the impact of the budget post its announcement will not be material.
So that's so true, Sunil. I've tracked the budget, I think, for almost a decade now. And every time we start the budget coverage, we say, hey, look, this doesn't assume so much importance from an equity market standpoint. And then we go on to cover it for about 48 hours. So I take your point entirely that we got to do what we got to do, right? But it's good to point out several times that from an equity market standpoint, not much can change. But this is an interesting time that the budget is taking place because we're heading into state elections as well. We have 5 states that go into elections this year. So in that context, Hiren, do you think that this could be a more populist budget with a rural slant? So there could be, more job growth opportunities laid out by the government. There could be, in terms of infrastructure spending as well, the levels could just be upped as we head into state elections. And in that context, are we headed for some kind of positive surprise in the budget?
So I don't know what the definition of a populist budget is, but I think if it means more spending in the rural areas, as I mentioned earlier, then I hope the budget is populist. Because I did mention early on that we really need to get, job growth and incomes in the rural areas up because, through the pandemic, the impact has been very, very substantial there. Now, obviously, you don't want to kind of just do doles or giveaways. And I think that if this is spent on rural schemes where infrastructure is built, I think I don't think there are any surprises anymore in the budget, if you ask me. I mean, you never know, but I think that it's just going to be business as usual. I think there is enough fiscal space. The government has already laid out last year the fiscal consolidation roadmap, which means that we are not going down to 3 and 3.5% of fiscal deficit immediately, which means that there is enough room. This year, revenue has been pretty strong. So I think that as long as we just execute on the CAPEX program that the government has laid out in the budget, and as long as we stay on the path of divestment, I don't think there are any great surprises in store as far as the budget is concerned. And I do, and as I said, let me reiterate that I hope the budget is a little populist. If that's what it means spending more in the rural areas, because we really need to get purchasing power back up there.
Okay, we need to take a break. We'll come back and carry this discussion forward. Gentlemen, stay on with us.
Okay, welcome back. You're with us here on What the Market Wants from budget, which is what, a week away now. Sunil Singhania and Hiren Ved are, of course, our special guests on the show. Sunil, thanks for waiting. Just a quick point. I mean, Hiren was talking about how, expenditure which should reach the bottom end of the economy should be helpful. Pump priming the rural economy is something which should be done. Over the last couple of months, I mean, more recently, actually, the global context has changed a little bit, right? I mean, it's generally the feeling is that financial conditions are going to tighten. Bond markets are doing what they are. So when we talk about more spending in one particular segment of the economy in the budget, it's essentially, it will have to be reworking the math. The government has, maybe rightly so, over the last couple of years, shown no inclination that they are willing to do any large amount of deficit spending. Your thoughts, Sunil?
See, while acknowledging that the last 2 months there has been some slowdown in the rural economy, but last 15-20 days are on the ground research indicates that rural in fact should be doing very, very well as we move forward. The produce of agricultural crop has been phenomenal. I think we are in the harvesting stage. Prices are pretty good. Sugarcane farmers are getting paid in time. And I think generally, at least our indication is that the next 2, 3, 4 months, as far as rural spending is concerned, is going to be pretty decent. As far as the government spending is concerned, I think we are all in sync that we need more, planned spending, which is more spending on creation of infrastructure. And maybe, a little bit of a public partnership kind of a push, which the government has been trying to give over the last 2, 3, 4 years in terms of creating this necessary infrastructure. I think more than the government spending, what is heartening is that finally, after 5 years, we are seeing private sector capex coming on stream, So whether it is utilities, whether it is metal companies, cement companies, across the board, whether it is on the EV front, on the renewable front, I think a lot of spending visibly happening on the ground. And I think that itself should ensure that the economy, is able to grow sustainably at 7.5%. As far as the global scenario is concerned, I think the Fed has already indicated 3 interest rates hike in 2022. There are reports which talk about 4 interest rate hikes. We are going to have a US Fed meeting very soon. It's, I think, a matter of, the event actually happening. At least my view is that the day the event happens, the day the first interest rate hike is announced, maybe that would be the turn day as far as the markets are concerned, and the concerns will then sort of ebb because that event has already happened and it's behind us.
Okay.
And that normally happens. And in isolation, only interest rate hike does not, on a sustainably basis have any impact on the equity markets. I think what we are seeing is a rebalancing as far as equity markets are concerned. Stocks which were the darlings and where valuations did not matter have suddenly started to be questioned as far as the valuations are concerned. And I think we are in that phase where maybe for the next 2-3 weeks, you might have a little bit of adjustment as far as positioning of the investors' portfolio.
Sunil, got that point, Sunil. But the big worry that I have is, and you look at today's action, for example, is that in this 2 to 3 week period, when this whole flush out happens, is this going to lead to such a severe price damage that it hurts the equity cult, retail cult? So much retail money in this market has been propelling us. In fact, the large part of rally is because of retail money, no longer driven by the FIIs.
I have been in this market for 25-30 years. I'm sure most of us have been in this market for years and years, and these kind of things have happened so many times. If you are indicating that if 2 weeks of correction would lead to a severe damage of retail cult, it has never happened in the last 25 years. I don't think it is going to happen in the next 25 years. And frankly, if retail investors are going to get concerned about 1 or 2 weeks of investments going up and down, then they are not investors.
Not if in those 2 weeks the prices fall 30-40%, Sunil, which has happened in some cases now. Zomato, for example, yeah.
Anuj, the prices in the markets always will be up and down. I always say markets are like cardiogram. They will always be up and down. I am very sure investors who are coming to equity markets are aware of that. And if you're not aware of that, then you are in the wrong market. You should be a fixed income investor, not an equity market investor.
All right. No, I think that is well put. These things, when we're in the midst of it, living through it, seem larger than life. But I mean, pull back a little bit, zoom out a little bit, and you realize that, well, these kind of things have happened many times in the past as well. Hiren, in terms of what the market does beyond the budget, what is your sense?
No, I think, I agree with Sunil, as Sunil mentioned, that we are currently in an adjustment process where the markets are adjusting to the fact that interest rates are going to rise. But if you look at it historically as well, right? I mean, there have been 2 interest rate hikes by the Fed between 2004 and 2006, where the Fed raised rates by almost 400 basis points, and then between 16 and 18. And in both those instances, over a reasonably long period of time during the complete rate hike cycle, the markets actually gave positive returns. I think what's important is that along with the cost of capital or rate hikes happening, how earnings pan out is very, very important, right? And I think as long as earnings support, I don't see a reason why we should be worried about the markets. And I think, internal corrections, intermittent corrections are part of the market. You can't expect every year to be like 2021, where the market keeps going one way. I think, and I've said this before, that we are now entering a new phase of the bull market where maybe the broad indices are give a much more, muted return, but individual stocks and sectors may continue to be in their own bull markets. And I think that adjustment process will continue. But on the whole, I think we are, I think this is still an asset class, which will give you positive real returns, given where inflation is and given where nominal interest rates are. I don't think that, you mentioned about retail investors. I think if you take a slightly longer term view, I think this is one asset class which will at least protect them from inflation.
Okay. Sunil, there's one consensus expectation that there would be a step up in terms of capital expenditure in this budget. The expectation is that there would be a 20% increase in capex after a nearly 6% decline that we saw in FY22. If that is the case, then does it make sense for an average retail investor to raise his allocation to this space, infrastructure, capital goods? It hasn't really performed up until now. But do you think that, there is a multi-year upcycle perhaps underway?
Sunil? Okay, sorry. No, I think there is definitely merit in saying that, after a rough last 5 years where capital spending was very, very muted, we are looking at capital spending coming up. The only problem is good capital expenditure companies are already trading at a significant premium to their historic sort of valuation. So I think while the sector is good, one has to be very careful on what one is investing. And, all these thematic things, some company declares that they are doing something on EV and the price moves up. I think that is something which one has to be very careful about. So while completely agreeing that the sector has a lot of tailwinds, I think the only problem is that the valuations has a lot of headwinds. Only one thing on the previous comment, Indian markets from 1st December 2021 to today are still positive. So despite all this volatility which we keep on talking about, I think markets overall are positive last 2 months also. I think I just want to leave you with that thought.
Okay, Sunil and Hiren, it was a pleasure talking to you. Thanks a lot for joining us. Of course, the countdown to the budget is on, and there are just 4 trading days left now, and of course, a week to go for the union budget. Well, that's a wrap on this special edition of What Market Wants. Just looking at the market, by the way, 822 points down on the mid-cap index. That's down 3%. It was down 750 points on Friday as well, the mid-cap index that is. And there's clearly a lot of selling which is happening in individual names. If you see the top traded screen, that's, almost everything is red there, led by Zomato, which is down 17%, but it's not alone. Stocks like Z Entertainment, there's Balrampur Chini, there are, Coffee Day, so many stocks which are seeing a bit of a decline. We'll take a break, and up next, of course, is Chartbusters.